Hi, Nigel Baker here, and a big introduction to the chair of our investment committee, Dr. Steve Garth. How are you, Steve?
I'm very well, thank you, Nigel.
Well, very excited to be here. We're in our new studio today in our brand new offices in the city in 60 Carrington Street, so it's exciting times here for the business. But what we're here to do today is review the year that was and have a look at what happened across the world. Been a very interesting year in global markets. So, Steve, let's start with the Aussie market. What's been going on?
Yeah, well, let's have a look both at the quarter, but you're absolutely right. We're at the end of the financial year. Let's go back and look at the full 12 months. Interesting, at the very start of this quarter, Nigel, oil had shot up by 80%. Inflation was high. People were talking about there's going to be an economic meltdown in the world. Good news is that hasn't happened. In fact, as you'll see in a moment, markets have done incredibly well. When you look at Australia here, you can see the modest gains in Australia, up 4% for the quarter. That's pretty good. Up 6.5% for the financial year. Yep. You can see Australia, it sort of gets going and then it gets knocked down by inflation, or it goes going, gets knocked down again by company earnings from some of the big companies. Bit of a seesaw pattern in Australia, but like I say, not bad, 6.5% for the full year return.
Yeah, fairly resilient. Obviously, we don't have the big tech and AI companies. Another interesting point around the Australian market, that the active managers, of course, who we don't use, really underperformed because they got hurt a lot by some of the big holdings, the CSLs of the world. So interesting there, while the returns are steady, but a lot of the actual fund manager performance was actually well below market that we'll see come through.
That's absolutely right. Look, it's something like 80-90% of the active managers aren't outperforming the benchmark. It's not very good for them at all.
Well, we don't recommend them. So moving ahead, Australia not too bad, but some really good returns overseas.
Yeah, so when we go overseas, Nigel, actually phenomenal returns. You can see here on the left-hand side, I've got the developed market index. Yep. Now that's mainly made up of the next three bars. The US makes up about 70%, and then Euro and Japan, or combined, they're about another 15-16%. So that's the bulk of the developed market. You can see developed markets up 12.5% for the quarter. That's huge quarterly return, and up over 15% for the 12 months return. And you can also see it's even across the board. So we've seen in the last few years, the US has really been leading, but this time much more even performance from all the contributors to developed markets. And on the right-hand side, that green column chart, that's the emerging markets. Look at that, up over 22% for the quarter and a phenomenal 35% for the year. Now, Nigel, you mentioned AI before. That's right, we don't really have those big tech companies. The US, of course, has got what everyone knows as the Magnificent Seven, and they've certainly been driving the returns of the US. But in Asia, they're the guys that make the semiconductors. And the semiconductor chips have gone mad over the last 12 months. In fact, the Korean Stock Exchange is up over 12 months, would you believe, 196%.
Incredible, huh?
And then Korea, a real laggard, it's only up 100%, and that's in Aussie dollar terms. So also goes to show the power of diversification, being across countries, being across markets.
That's right. I mean, standing here a quarter ago, there weren't many predicting that rebound after a little bit of a dip in the March, particularly in March, where markets were down 4 or 5%. So it just pays to stay diversified. Of course, it would have been nice to be all in on South Korea, but we're never going to do that. And it is certainly part of the global allocation, and investors have benefited from that. Australia, some investors might be disappointed, but again, a positive year despite what's been going on in the world. US allocations we've had have been fantastic, and the returns have been very strong. Of course, we don't forecast, but there are a lot of comments around where things are going to go from here. Again, just that diversification, stay in your seat, look at that asset allocation as we rebalance into the next financial year.
I think, Nigel, the last quarter, particularly, and probably the last year as well, been a great example on why it's so hard to try to predict what's going to happen. Now, in the last quarter, interest rates are high and inflation's up. Normally, that's bad for tech stocks. Tech don't like high interest rates. And yet, we've seen this incredible run on tech stocks. The other thing is that when inflation's high and there's geopolitical conflict that we've been witnessing, gold is meant to be a hedge against that. That hasn't done that. Gold's down about 14% in the quarter.
There's no longer a queue in Martin Place.
And there's no longer a queue in Martin Place. So the idea that, you can predict what markets are going to do based on what seems like common sense, it just doesn't work. Markets do their own thing. Don't try to predict the market. Stay diversified and stay disciplined, and you'll pick up the sort of returns that we're looking at here.
Yeah, very good. Now, across the asset classes that perhaps aren't as commonly talked about, but it's super important in terms of not only portfolios, but global trends and interest rates as bond markets. How have they been performing?
Yeah, so we'll just touch on this briefly. We're going to touch on bond markets via way of looking at 10-year government yields. Not everyone's cup of tea, I know. But actually yields are quite instructive about the future path of interest rates.
Explain what a 10-year government bond yield is.
Yeah, so a yield is government bonds, and the yield is basically the price of the bond. And typically when interest rates go up, then yields go up. But that means bond prices go down. A little bit confusing, but bear with me. Inverse relationship. What you can see in the chart here, though, is that in Australia, that huge jump up at the March because of oil and inflation and the end of the world type of stuff. But you can see that our yields have been coming down quite slowly. US, slightly different story. They're certainly rising in the early part of the quarter, coming off a little bit now. This plays into interest rates, Nigel. So bond yields are sort of a predictor of interest rates. When you look at what's going on in interest rates at the moment, I know we've been on hold in Australia for a little bit. I expect we'll stay on hold for a little bit longer, but I also think that we've sort of reached peak inflation, at least the data we've got at the moment, and you might expect interest rates to come down a little bit in Australia before the end of the year. US, slightly different. They're probably expecting rates to at least 1 or 2 more rise in the US.
Well, it's interesting. We've been seeing that in the pricing of just basic term deposits in the last few weeks, actually, starting to come off a little bit in that,
exactly
in that 6 to
right.
1 year.
Exactly right. And good returns for the bonds because the yields are coming down.
Very good. So again, another fascinating year. I mean, look, it's fantastic to have you as part of this. A big objective for our clients is to keep that message consistent, know that they've got peace of mind and good people around. And we do get a lot of that feedback that having you here helps them know that we've got a really strong process around what we do. We look at everything in a lot of detail. It's not like we don't take interest in what's going to happen, but we certainly don't use that predictive methodology, and that's worked for a very long period of time. So is there anything else we need to cover off on world markets before we go?
I think we have covered the year and the quarter in depth for our viewers.
Well, you're here in our new office. You're going to help us have a little opening drink later on. So great. Thanks for being here again, Steve.
Yeah, terrific. Thank you, Nigel.